first thing I'm going to think about is what is their time horizon, and do our time horizons align? Because if I want to go build a business for the next 20 years, for example, Matthew Coren Fresher, he wants to run that business forever. I'm the perfect investor for him because I want to own the business forever.
If you're an entrepreneur that just wants to do your own thing and doesn't want to have to answer to anybody and doesn't want help from anybody, and those people exist, and there's nothing wrong with that, don't come to OMERS, and I imagine don't go to Damien. I mean, there's all types of investors. Some are extremely active, in which we would be part of that group. You know, we look to take a board seat in every company that we invest in. Also, talking about boards, you take money from OMERS, you're no longer going to control your board. I don't want to control your board, but we're going to set up a good governance structure to manage that business. So if you're an entrepreneur that wants to maintain control, again, absolutely nothing wrong with that. You need to be very careful on, or very specific on the type of investors you go to. The wrong type of investor is just wrong for you. It could be very right for the person sitting next to you.
So, you know, the one thing, if I'm in your shoes and I'm looking for an investor, the first thing I'm going to think about is what is their time horizon, and do our time horizons align? Because if I want to go build a business for the next 20 years, for example, Matthew Coren Fresher, he wants to run that business forever. I'm the perfect investor for him because I want to own the business forever, right? But if you go to a fund, and I don't think you have restrictions on this, but I mean, there's limited cycles. You have to exit. So you've got to look at how long does the fund have in its cycle. You've got to look at things like, are they an asset manager? Will you be dealing with this person for the next 5 or 10 years, right, in terms of a partner? One of the wrong investor, we see term sheets for our companies every day. You know, when you've got 17 companies, someone's always going through a financing or being approached. But you can quickly look at a term sheet and see if it's a financial instrument or a partnership. Are they, you know, sitting on the board is one thing, but they can control your company in so many different ways. One is they can tell you when to sell your company or not sell your company. It should be a board decision. When you can finance your company or not finance your company, it should be a board decision. I saw a term sheet the other day that said, you can only sell the company if you return us 3 times our money. Well, what happens if you don't return the company 3 times their money? Well, they're going to ask for 3 times the money, even though the company, it doesn't sell for 3 times the value of the company. So I'd be really careful about the terms and less focused on valuation, and to me that would be a good partner.
Yeah. Does everybody know, you know, you mentioned something about the structure of a funds, and funds have cycles. Does everybody know what that even means? You know, I give a lot of these talks, and it's usually a slide that people have a lot of questions on, so maybe take a minute and describe what we're talking about exactly. You know, when we start a fund, a traditional fund, right, we have some uniqueness actually, and both of our funds are quite unique. So let's talk about a traditional venture fund like Sequoia. You know, Sequoia raises a fund. They have to raise money also. So they go to a bunch of investors and they raise a large fund. For this example, let's call it let's say Canadian fund. So it's a $100 million fund, not Sequoia. You know, so that fund starts. When they raise the money, that's day one. Typically, I'm going to generalize here, they have 5 years to make new investments. So that's called a commitment period or an investment period. After that 5 years, they're no longer allowed to make new investments out of that fund, right? So you have 5 years to approach that fund. Now, if they're a good fund, they're going to raise a second fund after 5 years, right? But why do you care about that? A, if you take money in the first fund and they raise a second fund, in 99.9% of cases, that investor is not allowed to take money out of the second fund to follow on in your business, right? That's called cross-investing funds. So it's important to you because if you go to a fund and you ask for money, and you know that you're going to need to raise multiple rounds of financing in the future, and you look at that fund and it's a $100 million fund, and you do the math quickly looking at, you know, there's lots of websites that you can find this, and you see that they've invested 80 out of the 100, maybe not the right fund for you, right? Because you know that they're going to be out of money soon. And once they're out of money, they're out of money. The fund can't go out and raise more. There's other ways, I guess there's ways they could do it, but generally speaking, they can't just increase the size of the fund. Similarly, time is a factor. So, you know, funds have a life. There's the first 5 years is the commitment period, but in generally speaking, after 10 years, the fund's over. And so what does that mean? If I'm a fund manager and I hit 10 years, First thing is I stop charging fees to my investors, and that sucks for me, and therefore, usually it sucks for people we work with. But so what happens after 10 years? Well, one thing that could happen is my investors can actually take the management of the fund and get somebody else to manage it. So why do you care about that? Remember that 10-year relationship I was talking about, and you thought you were taking money from Danny, or you thought you were taking money from me, and we're going to have this great working relationship? Well, now all of a sudden you got to work with somebody else, and you didn't have any choice in that matter. That's not fun, right? Now, what typically happens is I go back to my investors and I say, don't worry, I have a couple investments left. I'll manage them, and I won't charge you fees, and nothing happens. But the point is, there is a line in the sand, and that can affect you. So again, if you have options, which isn't always the case, and you're dealing with two funds and everything else is equal, and one of the funds is in the first year of their fund and the other fund is in the fourth year of their fund, I would tell you go with the one in the first year of the fund. All this stuff, I mean, I'm getting into some details here, but the point is there's more to it than just who's willing to write me a check. And you got to do your homework, and you got to learn about the business of the fund and where the fund is. And the only reason I tell you that is because I would want to know if I was an entrepreneur raising money from a fund. I'd want to know these things. So talk to friends, talk to advisors, talk to entrepreneurs who've been around the block a few times and have raised money, have dealt with funds.
Yeah, and also leading up to the fund, I mean, be careful how you structure the money you're raising from the angel investors. I mean, that's so key to us as well, because if you go raise money at too high a valuation or structures that don't work, it's going to make it really hard to go get capital from funds.
One of the questions I remember reading on that page was actually a good one. Is how do you find out if a fund is a good fund to work with? So I'm an entrepreneur, and I meet with Danny. And he says, great, Damien, I love your business. I want to give you $1 million. What do I do to find out if I even want to work with you?
That's a good question, because when we go and invest in your company and you've got 100 customers, I'm going to call about 30, 40 of your customers up, right, and do my diligence that way. In fact, we do so many customer calls, that's how we get comfortable that the technology works, because if the customer's happy, then I don't even have to check the technology, right? And so it's the same thing that goes for you. When you're looking at a fund, you should look at the portfolio companies and really go interview the CEOs. One, it's a great learning experience for you to see what other people are doing. But go spend a few hours with the CEOs, and they'll be very honest with you. Like, there are people in our portfolio that don't like us, and there are people that love us, and understand why the case is, and understand what they like and what they don't like. And I think that would be really, really key.
I promise you pick up the phone and cold call one of Danny's CEOs and say, hey, I'm thinking of taking money from Klass Capital. Can you talk to me about what it's like to work with Danny? They were in the exact same position you were 1, 3, or 5 years down the road. I promise you they will spend 15 minutes on the phone with you.
Absolutely.
And help you. And again, it's your brethren. Like, you're in the exact same situation. And what I would say is, don't just call the companies that are on the website, right? Find out what the other companies that they invested in. Find out who the failures were, right? When a CEO asks me who they should call, which I wouldn't suggest, I would go and find out yourself. I tell them, here's a list of the companies I've worked with. Here's the ones that were successful, and here's the ones that weren't successful. You really want to find out what it's like working with me? Call these ones. Call the ones where we had dark, dark days on the board. And again, if I was in your shoes, I'd want to know, before I take money from Danny, what's he going to be like when I miss budget 2 quarters in a row? Is he going to be all over me, or is he going to be trying to help me? Right?
It's a good point. When I started the business 6 years ago, I intentionally chose advisors that really challenged me. And I think, and I can tell you 100% we're 10 times better investors and partners because of the advisors that we surrounded ourselves with that always didn't say, yes to everything. And the same thing with the partners that you choose. I think you should choose partners that are going to help you and challenge you, not the partners that are going to be not active and kind of take a distant approach. And the problem when you raise money from 10 different parties versus 1 or 2, no one really cares. I've been in portfolio. That's another mistake I made early on. I ended up investing a small amount in a company, and there were 6 or 7 different investors. And I really didn't care. You know, I haven't paid attention to the company. It's been a tiny investment for me. It's not meaningful. It's not going to move the needle. I didn't follow one when other people followed on. I would really think about taking 1 or 2 partners, not multiple partners, and people that actually care and have a vested interest in your success and that are going to wear that success or failure.
Totally agree.
We do get a lot of emails every day looking for capital, right? And it's almost impossible to respond to everyone's requests. It's through the relationships. The people that come to us, at least, are through relationships that we have and building relationships that way. I think it's easier than just sending a long email and meeting us through email.
Yeah, I mean, I actually had this discussion. One of my colleagues is in the audience here, and on the way in, you know, I was saying how I probably meet with less than 5% of the entrepreneurs that reach out to me. However, I meet with 100% of the entrepreneurs that are referred to me. And I do that because I trust the people in my network. If Danny calls me and says, hey, I just met with an interesting company, you should meet with them, the answer is always yes. When it's a cold intro, then the screens go up. And you know, at OMERS, we see over 500 deals a year. We can't meet with everyone. And so what I would challenge you to do when you're trying to meet with investors, you know, we have broad networks. That's part of our job, is to keep those broad networks, figure out that network, and find a way in through that. So use one of your, you know, have advisors, leverage those advisors for intros. I think you'll find you'll get a lot more success.
Yeah, you know, we're not, it's going to sound, when I listen to what we're saying, it sounds like we're bad guys. We're not bad guys, we're just running a business. You know, the thing that I learned about being in the venture business is it's a business the same as everyone else's business. When you look at the customers, you're going to spend the most amount of time with the customers that you think you're going to win, ultimately. And so you've got to look at it from that perspective. Also, when, for example, I don't do seed or early stage deals anymore. We just don't do it. It's a company typically that has $1 million plus of revenues. It's got a recurring business model. It's only an enterprise software. So why come and some people are very forceful about taking a meeting, but if I'm going to waste your time, you're going to waste my time. It doesn't make a lot of sense. And I try to be very respectful of entrepreneurs' time, because you've got to, the last thing you want to do is waste your time raising capital. You just want to get on and run your business. And so meetings that don't make a lot of sense, it doesn't make sense for both of us to meet.
You know what's interesting is, you know, back to the know who you're taking money from and the difference in funds, you know, a couple things. So, you know, Danny just said he doesn't care how big the market is. We do care how big the market is. And I could put 10 different funds in each of those buckets, very, very different type of investment philosophy, and there's reasons for that, right? I mean, Danny already said he's investing 20-30% of his own money in the fund, right? At OMERS, we're managing pension plan money. You know, it's a $100 billion pension plan. We need to invest in investments that are going to move the dial, right? So putting $1 million into a company and generating 10, while it may be fantastic for some investors, for us, we kind of got to sit there and go, was it worth our time? You know, we're looking for investments where we have visibility to deploying $10 to $20 million into each one of those deals, where I guarantee you, you know, Danny wouldn't have those same type of characteristics. So again, get into the detail.
Absolutely. And if you look at our 2 portfolios, I mean, they're going to have, OMERS will have much bigger exits than us, and they look for those exits. I don't expect our companies to exit for $500 million. Damien's going to have 5 companies or more that exit for $500 million or more, right? And so, you know, for me, if I put out $5 million and I can turn it to 50 and 2 or 3 is my own capital, I'm really happy with that outcome. And I look for niche opportunities that are defendable. We've never lost money in the venture space, and we've never lost money so far, knock on wood, is because we're very conservative, and we're not looking for those moonshot, or whatever the right word is, those rockets out there. We're looking for great, sustainable businesses that are going to grow at 35 to 50% and be really capital efficient, and hopefully not lose get to the point where they've reached some scale. Maybe it's at 10 million of revenues where they're no longer losing money, and we're delighted if they're growing up north of 40% at that point.
And you know what's interesting? If in our case, when we're sitting around the table, if we don't have a certain number of our portfolio companies that turn to 0, we're mad, because it means we didn't take enough risk. So again, very, very different investment philosophies across funds, and you got to get to know that stuff.
I will never, ever sign an agreement with anyone when buying or investing in a company that I will not invest in your competitor. So we are in the business of investing. We're also in the business of putting in place the right firewalls in place to be careful about that. It's just, if I was investing in a logistics company and someone said, don't worry, we'll never invest in another logistics company, I wouldn't believe anyone, because you're in the business of investing. If you look at owners, they've got a massive portfolio. There's no way you can tell owners who they're going to invest in or not invest in. And that situation did happen to us, and I find that interesting. We invested in a company called Tractic, which does incident management for security guards. And then we acquired a company called PPM, which actually did incident case management. And he thought we'd go in that direction of the case management side of it as well. And so what happened was, I found an independent person to go on the board of Tractic, and I was on the board of PPM. What's interesting is PPM became Resolver and focused on risk management, and Tractic actually became a real enterprise solution for field services. So, companies have a life of their own and they go in their own direction, but you need to have a partner that is respectful of the situation. But Sequoia and all these big funds, naturally, they're so big, they're going to have companies that are competitive. Is that consistent with your thinking too?
Yeah, I mean, sometimes you can't help it, right? Back to one of the points I made at the beginning, where companies pivot, and a lot of times you're doing something different at the end than you were doing at the beginning. You could have two companies converge in the same space, and it's happened to us. What I do try and do, though, I do try and stay ahead of it a little bit. I mean, I can't control what the rest of OMERS does, and so we're such a large investor in various markets that there's always overlap. But what I would say is, I sit on the board of Wave, which is an accounting and payments platform. If an accounting platform came to me and said, hey, we've got a pitch, that's really interesting, we'd love you to look at it, I would place a call to the CEO of Wave, and I would say, hey, Kirk, there's this company that, I don't know, it may be competitive, it may not. What do you think? And if he really felt strongly that, look, I would really prefer you didn't invest in that company, we are squarely competitive against them, I would elect not to take that meeting. However, you said it, some of the large US funds, you go look at their portfolio, they have multiple companies that are competitive against one another. And a lot of times they figure, hey, we're such a big fund, we believe in a space, we just can't pick who's going to be the winner. So we're going to invest in a bunch of them, and one of them will percolate to the top.